I told you it's very easy. Right? It is levied in the year in which gains are realized so that funds are available to pay capital gain tax. Right? So basically, if you sell any asset, so there's a difference between the buying and the selling price. So that part is known as your capital gain. So on that capital gain, you have to pay capital gain tax. Right? Now, there are some exceptions. If you sell certain assets, on that you don't have to pay capital gain tax. Right? So one point is very clear. It will be taxable in the year in which the gains are realized, so that you have ready funds to pay capital gain tax. Second, capital gains is usually not calculated in certain cases. What are those cases? Privately held motor cars. Main private residence in which I am living. If I have two houses, I am selling the other one. So on that I have to pay capital gain. If I have one house and I am living in that, I was living in that, I am selling that. So no capital gain. So private motor cars, no capital gain. Main residence, no capital gain. Foreign currency. For personal use. British government securities, no capital gain. Small tangible movable assets, right, worth less than 6,000 pounds. You might have furnitures, antiques, jewelries, right? So on these we do not charge capital gain tax. In India, we call it as capital assets, and there are certain capital assets on which we don't have to pay capital gain tax. Means even if you sell it, you have some gains on that, but still that gain will not be chargeable to tax. So this exception is quite similar to what we have in Indian law, but still there are some differences, right? So you need to remember, if it is private motor car, company's main person's main residence, British government security, bonds, small tangible assets worth less than £6,000. Now, capital gains is like simple sale price minus purchase price Now, in many countries, they might consider index cost, right? There are two considerations. First of all, say for example, if you are selling through a broker, you are paying selling commission, right? So, sale proceeds should be considered net of expenses for sale, right? And if it is purchase, if you have paid something at the time of purchase, I have to add it. Cost associated with purchase must be added, right? Basically, commission paid at the time of purchase will be added, and commission paid at the time of sale will be subtracted from the sale proceeds. Any expenditure to enhance, say for example, two flows, and I added one more flow. So cost of improvement will be added. Cost of improvement will be added. I had a jewelry. In that 4 diamonds were there. I added one more. That's cost of improvement, right? So it is very clear in which you realize it. These are the exceptions, and this is how the gain is calculated.